Glencore and Rio Tinto have restarted talks over a potential megamerger nearly a year after a similar discussion collapsed. They've revealed little on what a tie-up may look like, saying the talks are preliminary and there's no certainty a deal will still be agreed to. If it goes ahead, though, the transaction could involve an all-share merger with Rio Tinto, the larger of the two potentially acquiring Glencore. This would create the world's largest mining group at a time of rising demand for copper and other critical minerals. Under UK takeover rules, Rio Tinto has until early February to either make a formal offer or walk away. Let's take a look for more.
Rio Tinto is in early talks for a possible acquisition of Glencore. The deal could potentially create the world's largest mining company with a combined market value of nearly $207 billion. The company said the expectation was it would involve an all-share buyout of, quote, some or all of Glencore by Rio Tinto. They did not disclose whether there would be a takeover premium or who would manage the combined company. These are the second round of talks in just over a year after Glencore approached Rio Tinto in late 2024, but a deal did not proceed. The miner said there was no certainty that the terms of any deal or offer would be agreed upon after the Financial Times first reported the revived talks. Rio Tinto, the world's biggest iron ore miner, has a market capitalization of about $142 billion, while Glencore, one of the world's largest base metal producers, is valued at $65 billion as of its last close. Under UK takeover rules, Rio Tinto has until February 5 to make a formal offer or to say it will not proceed. But if a deal pushes through, the transaction would be the world's largest ever mining deal according to LSEG data. US-listed shares of Glencore were up 6% after the talks were confirmed, whereas Rio Tinto's Australian-listed shares fell as much as 6.4%, the biggest intraday fall since July 2022. One analyst told Reuters, quote, there is a risk Rio could overpay.
Hyundai has been bullish in South Africa after a solid sales year, even as competition intensifies. The South Korean car maker sold more than 36,000 vehicles in 2025, ending the year as the country's fourth largest motor brand amid the rapid entry of Chinese rivals. Sales were led by the Grand i10, with strong demand also coming from Hyundai's compact SUVs and light commercial vehicles. Now, the company says consumers continue to prioritize value, reliability and after-sales support in a crowded market, with overall vehicle sales in South Africa rising sharply last year. Hyundai believes its local strategy leaves it well placed to compete in 2026. South Africa's trade deficit with its Brics partners has widened sharply. A new survey shows the gap has more than tripled since SA joined the bloc in 2010. The deficit now sits at over $13 billion, while trade volumes have grown. South Africa's exports to Brics partners remain concentrated in raw materials and agricultural products, with little uptake of locally manufactured goods. The research questions whether SA is extracting enough value from the partnership and calls for a treaty to be established to eliminate tariff and non-tariff barriers. Further afield now, oil producer Chevron is in talks with the US government to expand a key license to operate in Venezuela. This is so it can increase crude exports to its own refineries and sell to other buyers as well. Here's some more detail.
The U.S. government may allow oil giant Chevron to increase its crude exports from Venezuela. That's according to 4 sources, who told Reuters the two are in talks about expanding a license the company has to operate in the South American country. The change would allow Chevron to boost exports to its own refineries and sell oil to other buyers. The talks come as Washington and Caracas continue discussions about supplying up to 50 million barrels of Venezuelan oil to the United States, and as President Donald Trump presses American oil companies to invest in Venezuela's energy sector. U.S. officials have said this week that proceeds from the Venezuelan oil supply will go to a U.S. overseen trustee. Proceeds are meant to finance supplies of American goods to Venezuela. Chevron is the only U.S. oil major operating in Venezuela, which it does under an authorization from the U.S. government that exempts it from sanctions on the country. As part of its sanction-hardening campaign to weaken Venezuelan President Nicolas Maduro, the Trump administration in July put additional restrictions on Chevron's license. Those restrictions reduced the volume of Venezuelan crude the company is exporting to the U.S. by 60%. The restrictions also deprived Venezuelan state-run oil company PDVSA of any proceeds from Chevron's exports. The license expansion would allow Chevron to go back to previous export levels, while providing Venezuelan crude to business partners that could allocate the oil to destinations other than the U.S., as the company used to do in the past. Sources said Washington is also pushing to have other U.S. companies involved in oil exports from Venezuela, including refiner Valero Energy, which was a customer of Venezuela's PDVSA before the sanctions. The U.S. is also pushing to get oil majors ExxonMobil and ConocoPhillips involved as well. Their Venezuelan assets were expropriated 2 decades ago. Chevron, Valero, Exxon, and Conoco did not immediately reply to requests for comment.